Hello, everybody, and welcome back. Today, my guest is Phil Lee. Phil is a portfolio manager of the Asia Growth Fund at Mirae Asset. Welcome, Phil.
Hi, Thomas. Thank you for inviting me.
Phil, Evergrande is currently moving markets. What effect does it have on Asian stock markets, and how is the current situation?
Right, that's the news dominating these days in the Asian market. But honestly, that's more like a company specific issue in our observation for last few years. This company is most levered developers in China, and then the other general company, in ordinary developers has much better shape. And in terms of a contagion risk to the system, I have very little, I don't see much chance to do it because the banking system in China is much better than we expected in terms of loan reserve ratio is above 3% versus 0.8% in European countries, and also similar level of loan reserve ratio in the US. So meaning that if there are some issue, the bankruptcy issues, including Evergrande and other weaker developers, still China banking system is enough sufficient to embrace the loss. For your information, the Evergrande has 0.2% loan to the total system in China. So that is quite okay number to observe by the system. Of course, we have some negative impact on the whole economy, but it's not about system risk. That's the reason mainland Asia market relatively okay last couple of months, despite of this risk, because many people consider it as a company specific issue rather than system issue.
Internet stocks, most notably Alibaba and Tencent, have been hurt by the Chinese government's regulation wave. So how is the situation now a couple of months later, and what are the perspectives for those tech giants?
That the regulation hampered the sentiment for this giant internet platform last couple of months. And then current share price seems like a price in all bear scenario. My view is that we have to accept that the lower growth outlook for this company, but it didn't change much for their market dominance. Still, they are largest platform in China with multiple business opportunity. I have to lower this growth outlook. Let's say before we had a 25% plus revenue growth for Alibaba, but now is below 20% in couple of years, but still is growing. And then the valuation multiple is only 15 times for Alibaba. Then that is too cheap because platform business has different meaning, kind of a good characteristics. One is that it has good growth potential into different business area. Now we see that potential is limited. But second, the platform business means high ROE with lower capex, it's pretty asset light characteristics. So with a high profitability ROE business, and then 20% CAGR growth in coming years, and then trading at the 15 times, then it clearly indicating quite a good, attractive valuation. Maybe key concern is that government continue to ruin this business model, and then maybe in concern about ownership change or any other harsh measurement. But to me, it's more like a control of excessive growth of this internet giant. So within certain the restraint growth range, I think government will allow them to perform to serve the public in China. So my answer is that, okay, lower growth outlook, but still it has value, especially in this suppressed price. So that's the reason we still has exposure to Alibaba, Tencent, even though it's quite maybe lower than benchmark.
The term common prosperity is going around in China. What does this phrase mean? And do companies have to prepare for further regulatory measures?
Right. The term of the common prosperity is exactly equal to tackling income inequality, which is pervasive in any other country in the world. Government, China is through the massive urbanization and economic development, the income gap has widened in absolute term. The relatively term Gini coefficient has been stable for years, but the absolute dollar gap between wealthy and the poor has been widening. And then government, especially ahead of next year's new third term for the Mr. Xi Jinping, they should tackle this issue seriously. The implication for us is that it might put pressure on the listed company. Let's say they should care more about their employees, and then also they should care their consumers and users rather than minority shareholders like us. Then that's the reason I think we should put some discount valuation multiple on Chinese company. However, it doesn't change much for their outlook. There are many still growth opportunity, and then some company will deliver exponential, remarkable growth in coming years. That's how we play. Lower valuation multiple, but we continue to see growth opportunity from the many Chinese company.
So 2020 was a fantastic year for Chinese growth stocks. Currently, we're facing some headwinds. Why is there still a case for investing in Asia growth stocks?
Let me rephrase the question. Maybe last year was more for bull market for internet business model. This year, as we have seen from the China, also to some extent in other country, internet business model has challenged. First, cyclically, after COVID, post-COVID, the impact has been substantially subdued. Positive impact has been subdued. And the second, there are more and more regulation to rein in this internet business model. Why Asia growth opportunity this time? Is because other Asian country has a different set of growth opportunity. The semiconductor, especially from the Taiwanese, the TSMC or MediaTek, other semiconductor names, it has another big cycle because of AI, automation, the autonomous driving, and cloud, mobile. That's we can find a good growth opportunity from the non-China Asian countries. Also, India is another booming economy. It has been somewhat subdued. It delivered subdued growth last couple of years, but in our analysis, it seems like going into very strong upcycle in terms of capex, in terms of housing investment. So we see more genuine growth opportunity from India. Top of that, internet business model also has very good opportunity non-China space. China is more like a early mover to embrace internet business model, maybe 5 years earlier than any other emerging Asia. And they now face regulations. But other Asian countries still very, very early stage in terms of penetration, in terms of internet infrastructure, including fixed line and mobile network. To me, it just started. The India now currently has many, many new startups in the exploiting the internet business model, ASEAN as well. So that's another important growth area that ASEAN in India will now have very good business opportunity for internet business model. So it's good to have a regional exposure. China has their own strength and the growth opportunity other than internet. Emerging Asia has a genuine growth opportunity in internet business model and then their own specific industry like semiconductor in Taiwan, in Korea, and IT service business in India. So still, I can see a lot of variety of growth opportunity in Asia. That's the reason we always highlight the growth opportunity in Asian region.
So you already mentioned the semiconductor industry. The world is currently experiencing chip shortage and a chip boom. So is this a short-term exaggeration or just the beginning of a long-lasting increase in chip demand?
To me, it's more like a short-term disruption of supply issue. This time around is more about Malaysia, where the pandemic, the case is rising, continue to rise. That is a choking point for many semiconductor supply chain. But sooner or later, I think it can be resolved, maybe sometimes early next year. But still, I think there are very good structural elements for the semiconductor industry. The first one is that the big data analytics, and as well as autonomous driving will be a big implication for semiconductor. We need more chips, especially for smart car. We consider the each car with a level 4 of a autonomous driving can be another moving data center, which means it needs huge computing power and chips. It's very structural changes. And then some of the company will benefit directly, like a TSMC, who has 55% of global market share in the chip boundary. Also, there are some the rising chip design house like a MediaTek. The second point is that China want to build their own semiconductor supply chain. It's a big thing. When it comes to geopolitical tension, that is the most important critical area. So China must have their own supply chain for semiconductor. Then there will be a lot of investment, and then also there will be some inline interest by Chinese hardware makers. They will buy more chips from Chinese supply chain. We saw some emerging Chinese semiconductor company, which is also part of our portfolio. That is another big thing in coming years to support growth China semiconductor industry.
So this was Phil Lee from Mirae Asset. Thank you very much, Phil, for being with us today and sharing your insights.
Thank you, Thomas. Thanks, everyone.